Let's also welcome on board Tushar Pradhan and chat about markets further with him. Tushar, hi, good morning. Good to have you on the show. Tushar, inflation is a core reality here, although the RBI chose to hold fire. Just wanted to understand how is it that you're looking at the macro landscape right now and how equity markets are likely to move? Because clearly we seem to be climbing the wall of worry as we did back in 2022.
I think this is again not a very simple situation we are all in. I think the authorities in India have a very, very difficult time because it's a very complex situation. On the one hand, you are trying not to dampen the fledgling demand recovery that we are seeing. So you don't want to increase rates dramatically. On the other hand, you have inflation pressures coming up. And on top of that, you have a very significant borrowing program from the central government lined up as well. So when you put all of these things together, it's not a very simple answer that one can have to say what should one do. So I can understand that there is, from a policy perspective, not an easy scenario. From an equity markets perspective, I think one has to focus on earnings growth. And I think that is continuing to remain robust. Of course, the fact remains that if the situation on input costs, especially on oil prices and the general supply disruption that we're seeing in the world, if it persists, I think we will have a situation where at some point of time, input costs will have a burden on margins and our earnings estimates need to be revised. But on the one hand, one should always remember that the earnings growth projected for this year, FY23 as well as for FY24 is extremely robust. So even if we do have some sort of adjustment downward, maybe 200 to 300 basis points on an average, I don't think it's going to change the whole picture dramatically. And I think the market seems to be giving a signal to that valuations have not come off dramatically. And I think that is one reason to remain optimistic throughout this period. On interest rates throughout this period, if interest rates continue to rise a little bit, I don't think in the presence of growth that has been ever a problem for equity markets. So I think there are enough reasons to remain sanguine, enough reasons to remain fairly optimistic about what's going to happen in the next few quarters.
Yeah, it is. Tushar, so for equity markets, how is it that you actually maneuver and, try and make your portfolio inflation proof? And is there a way of doing that at all?
Well, we hope so, in the sense that clearly equities are, an asset class where in the long run, inflation has always been able to beat. There are other asset classes which kind of hold your asset value. But I think if you're looking for growth and actually even take advantage of inflation, I think equities remain one of the best asset classes to play it. I'll tell you why. Because if inflation starts to come into prices and especially revenues, so for example, companies will have to increase sales prices because of input cost pressures. That actually translates into higher revenues and eventually into higher profits as well. So it is a counterintuitive situation. But I think as long as growth persists, which means that there is demand for goods, I think the higher inflation can be countered by portfolios of equities. I think everyone should understand that if you are looking at an inflation scenario, clearly fixed income, which has a certain limitation in terms of adjusting to inflation, at least in the short term, will be challenged. And in your portfolios, I think some exposure to equities is definitely warranted.
Tushar, hi there. Good morning. I wanted to also break it down when it comes to the outlook within the auto space, because it seems like lingering concerns with respect to semiconductor chip shortage, raw material price inflation, all of that could hurt profitability in the coming quarter. Do you believe that now with the situation of semiconductors having eased, albeit very marginally, as well as dealer inventory looking a little bit normalized, that things could be improving?
No, I think there is always reason to believe that the chip shortage is not permanent, right? So I think what we were initially thinking is that the chip shortage could be short term. However, I think the only adjustment to the view is that it may last a little longer, continues to remain a short term problem. Just to give a little bit of a backdrop to the chip situation, as you know, these days, chips are being used in absolutely every machine, or I would say device that we are using, which means that the supply constraint is not really just from a manufacturing perspective, but it is also from a usage perspective and a demand perspective. I think and as every market takes some time to adjust to the new demand, it will take some time. On top of that, we've got some supply shortages coming out of China following, the outbreak of COVID there and the shutdowns that they're taking. I think the news that is coming now is that the authorities there are ensuring that supply chains don't get affected too much, and that even in spite of the lockdowns, they will ensure that there is some production capacity going on with adequate controls. So I think overall, we should expect that, some sort of improvement will happen, though the timing of that is not certain. And over time, I think, these supply chains eventually will normalize.
Are you convinced that, given that we're seeing a pickup in the overall economy, the things have started opening up now, construction activity is picking up, that the entire prospect and outlook for the cement sector is looking fairly buoyant? And in that light, would it just be a blanket positive call within the space as a whole?
Well, cement, I think we were very optimistic a few months back because, the opening up and the entire unlock trade. I think cement was a very central part of that entire theme. There were a lot of construction projects which are on hold. There were, significant public works which also were undergoing a lot of slowdown due to the impact of the COVID pandemic. So the natural outcome of that was that once the unlock happens, this is a very, very straight beneficiary. The situation has clouded a little bit because of just what we spoke about a few minutes ago, which is input costs. So one of the things which has clearly gone up is freight costs and especially transportation costs. And I think if you look at cement as a whole, this is a very significant input into that production scheme. So I would think that while cement will clearly move in terms of volumes, I think profitability will need to be judged in a sense that what are the trends of these input costs and what kind of realizations these companies are likely to make. But I think I will still put my weight behind the fact that there is demand, and I think cement will see a pretty decent growth in the next year or so.
Good morning. This is Nantara joining in. We talked about earnings in your first question and answer with Aisha. I want to just go beyond that. TCS done, Infosys today. We are in the thick of earnings season. What we've not seen is maybe because of the margin pressure, rising inflation, the kind of earning downgrades in the last quarter. Is that something that we need to be watching out for, worried about? And then what is that going to do for, the high PE stocks?
Yeah, that's always a concern because valuations, whenever they will adjust much more sharply in higher PE stocks simply because there's so much room more to give if there is any disappointment on earnings. Now, on earnings, I would say the situation is not uniform. So as I was mentioning, there are certain input cost pressures which are building up in the economy, and they will affect certain companies which really are part of that chain. But if you take, companies such as, say, maybe in the IT space, now the input cost pressures there are of a different nature. They are more from attrition, they're more from, the labor costs, which is probably climbing up substantially over the last 1 year or so. And the fact that the demand for IT services continues to remain at an all-time high, which means that the companies have very little choice but to continue to keep hiring at increasing costs just to be able to maintain that delivery of the demand that we see. So there are pressures which are building up, and that will have some sort of impact on earnings. But I think that's a good pressure. That's because it's driven by the growth in the business itself. So I would say that overall inflation will lead to some sort of cost pressures. And in the end, the net profit, for example, after all the input costs and the establishment costs is taken up, may really now trend a little downward from the earlier expectation. But we have to continue to remember that we've had significant tax reform, which means that corporate taxation is at a much lower level than pre-pandemic levels. And as a result, we will continue to see robustness in earnings. What we are talking about are marginal changes. and they may be downward in the short term. But I think as the demand sustains, and if we don't have any significant downgrade in GDP, I think earnings will not be at risk.
Okay. The other thing I want to ask you, Tushar, is, and you've always, when you've come, you've talked about being sector agnostic, right? And trying to find opportunities. However, financials is something you've been bullish on. With the up move that we've seen in financials, is it what's going to continue to lead to the rally, add to the recovery? Is that your biggest bet still?
Yeah, so there is a method to how we view things. For example, when we are talking about a significant up move in the GDP growth, what will fuel the GDP growth? It is essentially the financials which provide the capital for companies to be able to go forward. And as we see for the first time in many, many years, we believe that there will be a capex cycle building up, which will require significant amount of credit. We have seen a significant expansion in the financial space by NBFCs, largely targeting personal loans and a credit growth of a different kind than what we usually associate an economic upcycle with, which is corporate credit growth. This time around, I think the optimism on financial comes from both. One is that there has been a significant demand suppression during the pandemic, which will come back like a real bounce back. And on top of that, we see a significant capex cycle building up, which will also require significant amount of credit from the banking system. So which means that we now have a situation where as long as the interest rates are in control and that they do not spiral out of control, and then it becomes unviable for any capital project to actually be undertaken. Given that, we think that the financial space is poised for taking advantage of the GDP growth that we are estimating going forward. And that's the simple relation to saying that while we remain sector agnostic, the fuel for any of the sectors to do well continue to remain the financial sector. And that's why we are positive on that, because that's a proxy in some way or the other on the GDP growth. And I think as we go forward, I think we will see which sectors really demand more capital as they go along. And that is in tune with the kind of growth that they see in each of these sectors.
Tushar, there's a lot of debate about, how much more does the metal sector have in terms of legs to move further, while we've already had great 2 years. But, if the US bond markets were to go by, we are looking at an impending recession. If there is an impending recession, metals demand is also going to cave in. But at the same time, looking at the stocks here, it doesn't seem to be the case that, the rally is going to be ending anytime soon. In fact, more so because of the geopolitical crisis playing out in the European region, the exports are actually spiking up and prices continue to move higher. So just wanted to understand, where exactly do you think metals are going to move next?
Yeah, so I think recession is a big word. I think many people are kind of looking at interest rates and inflation together to signal a recession. I think the situation always, in every situation, is different, and it is fairly complex. Currently, what we see, the demand for commodities coming really is as a direct reaction to supply disruption. And there was a hope that this inflation was transitory. If you remember some of these words being talked about early, was because of the very fact that if it was really led by supply disruption, the minute supply chains come back up, you're going to see a very dramatic drop in inflation. So that was the expectation. However, as you mentioned, the geopolitical situation in Europe has really twisted the whole situation in such a way that this supply disruption is likely to persist. And I think if that continues to persist for a while, and if for various other reasons that inflation also persists, then there may be a demand contraction. And at that time, metal prices really will have nowhere to go except down. We have to also understand that some of these prices have remained high and have touched highs which they've never seen before. So obviously that is unlikely to persist. But I must say that there are certain economies in the world which will continue to demand commodities in spite of what is happening geopolitically, because they remain fairly domestic focused. And I think some of those commodities will continue to enjoy those prices for some time. So I would not say that we are on a commodity upcycle, which is a multi-year upcycle or anything like that. But clearly there is supply-demand mismatch, which will retain commodity prices at a higher level for some more time. That's what I would hazard as a guess.
Tushar, great to have you on the show. Good chatting with you as always. We'll let you go on that note.
Thank you so much.